Welcome back to On-Chain, the podcast where we go deep on DeFi infrastructure, protocol design, and what's actually building on the chains that matter. I'm Marcus. Today's episode is focused on something that went live recently on LeverUp, a perps protocol on Monad, a program they're calling AnyCollateral. The short version: it lets holders of supported Monad ecosystem tokens use those tokens as trading margin without selling them first. To walk us through how it actually works, I've got James from the LeverUp team. James, welcome.
Thanks, Marcus. Good to be here.
Let's start simple. Paint me the before picture. What's the problem that exists for a token holder today before any collateral?
Before any collateral, your options are pretty limited. Say you're holding a Monad ecosystem token, something you're genuinely bullish on long term. You want to keep that position, but you also want to trade. Maybe you want to open a BTC long or hedge something. To do that with any real capital, you have to sell your token, convert to stablecoins, then trade. You've exited your original position just to enter a new one. The capital is inefficient. The token is just sitting there, taking on price risk, doing nothing else. And the only way to activate it is to exit it.
And any collateral changes that how?
You deposit the token as collateral on LeverUp, and it becomes your trading margin. You open your BTC long, or whatever you're trading, and your exposure to the underlying token stays intact. You didn't sell, you didn't exit. The token is now doing two jobs at the same time.
Let me make sure I'm following. My token is sitting in LeverUp as collateral. I open a position, and if my token's price goes up while I'm in that trade, I benefit from both.
In principle, yes, though there's a flip side to that, which we should talk about because it cuts both ways. We'll come back to the risk mechanics in a bit, but the core point is right. The token stays in your portfolio exposure and gains a new function on top.
Okay, let's zoom out to the ecosystem context, because I think this makes more sense once you understand where Monad is right now. 5 months after mainnet, you've got over 400 million in TVL, more than 140 million transactions processed, a serious builder community. But a lot of that capital is still relatively idle from a utility standpoint.
That's exactly the dynamic we're designing around. Every successful ecosystem goes through a phase where there's significant token activity, projects launching, communities forming, capital accumulating, but the tools to make that capital productive haven't caught up yet. You have the assets. You don't yet have the infrastructure that lets those assets do more than appreciate or depreciate. Perps are a natural primitive for that layer. They give holders a flexible way to express market views, hedge, or generate yield off their existing positions without leaving the on-chain environment. Any collateral is the bridge between Monad's token ecosystem and that primitive.
Now, any collateral is a big promise. How do you actually decide what tokens get added to the supported list?
The name is aspirational in the sense that the program is designed to expand over time, but there's a real review process behind every token that gets added. 3 things we look for. First, real assets, verifiable on-chain liquidity and functioning price discovery. Not just a token that exists, but one where you can actually transact at meaningful size without massive slippage. Second, real communities, active holders, not just circulating supply that lives in 3 wallets. We want to see a genuine holder base. And third, real on-chain traction, actual usage, protocol activity, transactions, something that tells us there's substance behind the token beyond the ticker.
Once a token clears that bar, what does the integration look like for the project team? Do they need to do any development work?
Nothing. That's one of the design principles we're most deliberate about. No code changes, no new smart contracts, no tokenomics redesign, no staking mechanics, no voting integration, no burn additions. Nothing from the project side. Everything on the infrastructure layer, Oracle integration, settlement logic, the collateral parameters, the liquidation engine, that's all handled by LeverUp. Once a token is reviewed and configured on our side, holders can start using it as margin immediately. The project team doesn't touch their development roadmap for this to go live.
I want to push on that for a second. Why does a project even care if it requires nothing from them? What's actually in it for the protocol that added their token?
New utility for their holders with no downside to the token's existing structure. The tokens supply mechanics, vesting schedules, governance design, none of that changes. The token stays exactly what it is. LeverUp adds a new use case on top of it, and from a demand perspective, it creates a new reason to hold the token that didn't exist before. Traders who want to use it as margin need to acquire it and hold it first. That's organic utility demand. It doesn't depend on the project team's treasury activity, emissions programs, or buyback schedules. It shows up as real buying from a new source.
Organic demand is a phrase I hear a lot in DeFi. Can you be specific about the mechanism?
The mechanism is structural. To use a token as margin on LeverUp, you have to own it. There's no synthetic shortcut. You can't borrow the collateral position or represent it with a derivative. You hold the token, you deposit it, you trade. So if trader demand for a particular token as collateral increases, the buying pressure to acquire and hold that token increases proportionally. That's the mechanism. I'm not saying it guarantees price appreciation. Nothing does, but it's a meaningfully different source of demand than, say, a liquidity mining incentive or a staking lockup.
Let's get into the actual mechanics of how a position works. You mentioned each token gets a collateral ratio. What is that and how does it affect the trade?
When a token is added to any collateral, we assign it a collateral ratio, CR, a number between 0 and 100%. That number reflects the token's liquidity depth and volatility profile. The higher the liquidity and the lower the volatility, the higher the CR. In practice, a 70% CR means that for every dollar of token value you deposit, you have 70 cents of effective trading margin. So if you deposit $1,000 of a token with a 70% CR, you're working with $700 of effective margin for your position.
And the CR can vary widely between tokens.
Yes, a highly liquid, well-established token might earn a CR closer to the higher end of the range. A newer or more volatile token would sit lower. It's a risk-calibrated parameter, not a flat number for all assets.
All right, risk mechanics, let's go there. Because I think this is where traders can get caught off guard if they're not paying attention from the start.
This is probably the most important part of the conversation for anyone who's actually going to use any collateral. There are two independent risk vectors in every position. The first is the one you'd expect from any perps trade, the market movement of whatever you're trading. Long BTC and BTC drops, your position moves against you. Standard. The second is specific to any collateral, the price movement of your collateral token. If the token you deposited loses value sharply while you're in a trade, your effective margin shrinks, independent of how the trade itself is going. A severe enough collateral drawdown can trigger liquidation on a position that is technically profitable.
So I could be winning the trade and still get liquidated.
That's the dual liquidation risk, and it's real. The two risk vectors are independent. Your BTC long can be up, and if your collateral token has dropped enough to push your margin below the liquidation threshold, the position closes. Both sides of the equation need to be managed. This isn't a design flaw, it's the inherent nature of using a volatile asset as margin. But it means position sizing with any collateral needs to account for the collateral's own volatility, not just the direction of the trade.
What about the other mechanism? I've seen something called sub-1x force close mentioned. What is that?
That's the inverse scenario. If your collateral token appreciates significantly while you're in a position, let's say it runs hard, the ratio of your margin to your position size can invert. Your effective leverage drops below 1x, meaning your margin now exceeds your position size. At that point, the protocol automatically closes the position and returns the collateral. Clean exit, no manual intervention needed. It's a safety mechanism built in to prevent an edge case state where the leverage dynamic is no longer functioning as intended.
That's an interesting one because it's a risk in the direction most traders don't think about. Your collateral performing too well becomes a problem.
Right, if you're holding a token you expect to rally and you're using it as margin on an active trade, you want to be aware that a strong collateral move could close your position before you're ready to exit. Worth building into how you size things.
Let me ask about the bigger picture. Where does any collateral sit in what LeverUp is building overall?
The underlying thesis is that Monad's ecosystem tokens should be functional across Monad's financial infrastructure, not just tradable on spot markets, but actually productive. AnyCollateral is the specific expression of that thesis at the collateral layer. The loop we're building toward works like this. More tokens supported by AnyCollateral leads to more trading activity on LeverUp, which drives more protocol activity, which means more protocol value cycling back to support the trader ecosystem and LV-aligned incentives. The program expands as the Monad ecosystem expands. It's designed to grow with the chain, not just launch once and stay static.
So the supported token list will keep growing.
That's the structure of the program. It's not a one-time launch. We're actively reviewing applications and adding tokens as they meet the criteria. If a project is building on Monad and wants to apply, they can reach us at ac.leverup.xyz.
And for a trader who wants to start using it today,
Head to app.leverup.xyz. You can deposit a supported token and start trading. If you want to understand the collateral parameters in depth before you put capital in, the documentation lives at LeveruP, Gitbook, EO. I'd suggest reading through the risk section specifically before your first AnyCollateral position. The mechanics aren't complicated, but the dual liquidation risk is worth understanding clearly before you're in a live trade.
James, this was genuinely useful. The dual liquidation risk framing in particular, I think a lot of people will hear use your tokens as margin and think it's straightforward upside with no new considerations. It's not. Both vectors matter. Thanks for the time.
Thanks, Marcus. Good questions throughout.
That's a wrap on today's episode. If you're a project building on Monad and want your token reviewed for any collateral, the application is at ac.leverup.xyz. Documentation is at LeveruP Gitbook, EO. And if you're a trader who wants to start using supported tokens as margin today, app.leverup.xyz. Subscribe wherever you get your podcasts. We'll be back next week.